Welcome to Talk Tickers. Today, we're diving deep into the Q3 2025 earnings call for NPS, the power management solutions provider.
Yeah, this is a fascinating one because, well, the numbers just don't seem to match the market's reaction at all.
Exactly. There's this fundamental contradiction we need to figure out. NPS had a really clean beat, right? Revenue, earnings.
Both beat. And they actually raised guidance for Q4. You'd expect the opposite of what happened.
But instead, the market just hammered the stock, sold it off aggressively.
Huge selling pressure. And the volume, it spiked massively, something like 156% of the 65-day average. The stock just cratered.
So this huge disconnect tells us the real story probably wasn't just in those headline financials. It was maybe in the narrative or the expectations.
Our mission then is to figure out what the market was really looking for, what expectation management somehow missed communicating.
Okay, so before we get into the why, let's just quickly lay out the what's, the results themselves.
Right, set the stage. Because fundamentally, the quarter looked strong. They didn't just meet expectations. Arguably, they kind of crushed them.
Yeah, non-GAAP EPS came in at $4.73. That's what, 10 cents above the consensus, something like $4.63, $4.64 was the expectation.
A comfortable beat there. And revenue, $737.2 million. That was about $15 million higher than the street's $722 million estimate.
So solid beats. And the growth looked pretty impressive, too.
Definitely. This wasn't just, a weak comp or something. Revenue was up nearly 19% year over year.
And almost 11% quarter over quarter. Strong sequential growth.
So the company's clearly executing, and they back that up with the Q4 guidance. They guided revenue between $730 million and $750 million.
Which at the midpoint suggests continued sequential growth, about 1.7% quarter over quarter. Most reports frame that as above street.
Which just adds to the puzzle. Beat, raise, positive guidance framing. So where's the problem?
Okay, so if the top line and the near-term guide weren't the issue, it must be deeper, maybe profitability or long-term targets. Let's dig into margins first. They seemed a bit sticky.
Yeah, sticky is a good word.
Yeah.
GAAP gross margin was 55.1%, non-GAAP 55.5%. Just sort of stuck right there in that mid 55% range.
And that came up on the call, right?
Oh, yeah. It was clearly a point of friction. Management's take was that it's because of the short-term nature of the orders they're seeing right now. Meaning because the orders don't have that long-term visibility, it limits their ability to really manage the business mix effectively to, push those margins higher.
That sounds a bit like a classic volatility excuse, like demand's strong, yes, but the orders are too granular, too unpredictable to optimize properly.
That's essentially the argument. But they did talk about a path forward, pinning hopes on automation, longer-term stuff.
Right. They mentioned investing in their own fully automated test systems.
Exactly. But they were very careful to manage expectations on timing. The CEO basically said, yes, margins will improve long-term through automation and more system-level offerings, but, and this was the key phrase, not quickly.
Not quickly. So no immediate margin relief expected. That probably didn't help sentiment.
Probably not. It sort of kicks the can down the road on margin expansion. Why trust the long-term goal if the near-term mix is unmanageable?
Yeah, you can see how investors might get skeptical there. That could definitely fuel some selling.
It could. Though, to give them credit, they did emphasize how their strategy is diversifying the revenue streams. They really hammered home the end market breadth.
Okay, yeah, they broke down the Q3 revenue, right?
They did. Enterprise data, that's where the AI demand really sits, was the biggest at $191.5 million.
Followed by storage and computing, pretty close behind.
Right, $186.6 million there. And automotive was also strong, $151.5 million. So it's not just a one-trick pony.
And that diversification, that feeds into the CEO's main theme, the one they kept repeating.
The strategic transformation, yeah. Moving from being just a chip-only semiconductor supplier to becoming a full-service silicon-based solutions provider.
Selling whole systems, not just components. That's supposed to increase the value per customer, make things stickier.
That's the idea. And this shift, this whole solutions provider narrative, it really relies heavily on two main growth areas.
Which are?
Enterprise data driven by AI and automotive. Those are the keys to understanding where they think the future growth comes from and maybe where the market got nervous.
Okay, let's take enterprise data first, the AI piece. What was the message there?
Well, they had an interesting take. The CEO sort of acknowledged that the AI market can be a bit of a distraction.
A distraction? How so?
Because of the concentration risk, huge demand, but from just a few massive hyperscalers. and visibility can be tough.
Okay. Makes sense.
But their attitude was basically good money is good money. They want to engage broadly, show off their tech to anyone who's buying.
Fair enough. But what about the outlook? That's usually where things get sensitive.
And this is, I think, the absolute crucial point from the call that likely explains that big stock drop. When they were pushed on the outlook for enterprise data,
Yeah.
they projected really strong growth for 2026, like 30% to 40% revenue growth in that segment. Sounds great.
Then tis sound great. So what's the catch?
The catch was the timing. They immediately added a big caveat, that growth. It's expected to be heavily weighted towards the second half of 2026.
There it is. So the market was probably pricing in, what, an immediate boost, Q4, Q1 next year.
Seems likely. And NPS basically said, hold on, you need to wait maybe 12, maybe 18 months for that big inflection, that delay.
Yeah.
That's likely the root cause of the sell-off.
Right. The market heard 40% growth, but then realized it needed a telescope to see it. Ouch.
Exactly. And that theme of sort of delayed gratification carries over into their automotive expansion plans too.
Okay, what's happening in auto? They're moving beyond just the older stuff, like USB ports.
Way beyond. The new focus is on the really high-value areas. ADAS, advanced driver assistance systems, EVs, obviously.
Yeah.
And especially the big transitions happening there.
Well, like the move to 48-volt systems and 800-volt for the higher-end EVs.
Precisely. Plus things like zonal architectures for power distribution and full battery management systems, BMS. Big stuff.
Zonal architectures. For you listening, that's basically how newer cars are completely rethinking their electrical systems, moving away from one central brain. Huge potential, but
it takes time. Huge lead times. Management confirmed, yeah, zonal design should start hitting the market next year, 2026.
But the really big ticket items, the full BMS, the traction inverters.
Those are further out, projected for 2027 and beyond.
So, again, we're seeing this pattern. NPS seems to be winning the designs, getting spec'd in, which is great.
Definitely.
But the actual revenue, the big dollars, are still several years away in many cases.
That's the story. They did highlight one specific win, though, something they were clearly excited about.
Oh, yeah.
Their first design win for a full BMS solution, but on a robotics platform, not automotive.
Interesting. Robotic.
Yeah, management sounded like almost too excited to talk about the details of the client. But it's a strong proof point for their whole full-service solutions strategy.
And when does that revenue start ramping?
They projected that ramp starting in 2026. So, again, next year, not next quarter.
Okay, so now putting it all together, that market reaction makes a lot more sense, or at least the reason for it does.
Right. You've got this massive beat, a raised guide, but the stock still tanks 7.59% on the day.
And the volatility was just wild.
Absolutely staggering. You have to remember, this stock wasn't exactly lagging heading into the call. It was flying high.
Up nearly 28% in the last 3 months alone.
Way outpacing the SOXX index, the main semiconductor benchmark. So expectations were already sky high, maybe unrealistically so.
And when the timing news hit, the market didn't just trim expectations, it felt like panic. You mentioned the implied move.
Yeah, heading into earnings, the options market was pricing in about a plus or minus 10.4% move.
But the actual intraday low was much worse.
Much worse. It hit negative 13.9% at one point, just blew right past that implied volatility band.
So it really does seem like the sell-off was almost purely a reaction to that delayed AI growth timeline.
I think that's the core driver. The market wanted that sharp, immediate inflection. Management confirmed the growth is coming, it's real, but it's pushed out to the second half of 26.
Combine that with maybe some lingering background worries about, hyperscaler platform allocations down the road.
And investors just decided to de-risk, take profits after the big run-up, and wait for more clarity or closer timelines.
It's that classic Wall Street thing, isn't it? Good news isn't always good enough if it's not fast enough.
Exactly. The stock had been sprinting, and the CEO basically told everyone, okay, time to switch back to a marathon pace.
Right. Okay, well, this analysis of the volatility, the behavioral overshoot, maybe, it leads us naturally to our next segment.
The mandatory one.
The mandatory one, where we shift gears from just reviewing to maybe a little speculation. This is not financial advice, seriously. This discussion is purely for educational and entertainment purposes. Don't base any investment decisions on what you hear on a podcast. Okay. All right. So, given that extreme volatility we just talked about, the stock blowing through its implied move on the downside by almost 400 basis points.
Yeah, that negative 13.9% low was pretty dramatic.
It was, and it didn't hold that low, right? It closed significantly higher at negative 7.59%, around $1,005. That suggests the initial panic fear might have been a bit excessive compared to the actual news, which included a beat and raise.
So the thinking is that fundamentals provide something of a floor, maybe near that closing price.
That's the argument for this particular idea, yeah. A contrarian play, really. We're pitching a short-term bullish trade focused on volatility normalization.
Okay, how does that work?
The idea is the immediate downside fear, the reason for that negative 13.9% swing, seems to have been violently priced in already, maybe overpriced in that initial reaction.
So you bet against that extreme fear persisting.
Exactly. The trade idea would be something like selling the next week's expiration put spread. You're essentially betting that the stock finds support around that 1,005 level, or at least doesn't crater further in the very near term.
Because of the behavioral overshoot, the panic has likely peaked.
That's the bet. You're wagering that the massive fear driving that deep intraday low has been mostly satisfied, and the underlying strength of the quarter, the beat, the raise, provides enough of a floor to encourage the stock to maybe revert back towards the mean or at least stabilize after such a wild swing.
Interesting. So it's a bet on the market digesting that H2 2026 timing fairly quickly and maybe looking past the immediate disappointment to the longer-term wins. Less about fundamental value, more about the technical behavioral reaction settling down.
Precisely. Focusing on the dynamics of the reaction itself. Okay, so let's wrap this up. Let's leave you, the listener, with a final summary.
Sounds good.
NPS, operationally, delivered what looks like a flawless quarter. They're executing strongly on this big strategic shift towards being a full solutions provider. They're winning important designs in AI and automotive.
And they are projecting significant growth in that key enterprise data segment starting in 2026. The core challenge for them right now doesn't seem internal.
No, it seems external. It's managing these incredibly high, maybe even frothy investor expectations being driven by this whole AI upcycle frenzy.
Which leads us perfectly into that final provocative thought for you to chew on.
Go for it.
This company is pouring huge resources, huge amounts of time and R&D into these really long-term initiatives. Things like 800-volt EV systems, full BMS designs, stuff that management themselves say takes minimum 3 to 4 years before it translates into really meaningful revenue.
Okay.
So the question for you is, when you look at this Q3 report, and especially that sharp sell-off afterwards, what are you really seeing?
Are you seeing a stock that just sold off because of short-term impatience? Impatience about waiting for that AI ramp in the second half of 2026?
Or is that selling pressure maybe signaling something deeper, a more legitimate, longer-term concern or caution about whether NPS can actually secure the kind of material, high-value market share they need in those next-gen hyperscaler platforms or those advanced auto systems over that much longer 3 to 4 year time frame?
That's the tension, isn't it? The gap between what the market wants right now versus the realistic multi-year timelines required for these complex strategic victories.
That's the absolute central tension defining this stock right now, I think.
It certainly seems that way. All right, that's all the time we have for this deep dive. Thanks for joining us on Talk Tickers.